Bond Portfolio Guide. Learn the basics on building a portfolio of bonds. Retail investors generally flock to the stock market thanks to its supposedly easy to understand structure and broader coverage in the news media, with headlines largely heralding every day whether the market has risen or tanked. But according to wealth managers and asset managers, as well as such prominent investors as PIMCO analysts, the real money is made in fixed income securities, including bonds and treasury bills. Find out how to build a diversified fixed income portfolio that could generate positive returns on a risk-adjusted basis in the long term. Welcome back, folks, to another edition of Sweetie Kiwi. How are you doing today? I hope you are doing fantastic. If you are doing as great as I am, go grab a cup of coffee or tea or vodka. Let's roll. Today I want to talk to you about bond portfolio. I want to give you a bond portfolio guide, and I want to have a conversation with you around the basics on building a portfolio of bonds. First thing you have to understand is that there are some basics of bonds and bond funds you need to get. If you have primarily received your bond exposure with bond mutual funds, you will benefit from learning the basics of how bonds work. A bond is typically a promise to pay. If you think about it, it's just a loan. So the borrower is an entity such as the US government, a corporation, or a publicly owned utilities companies, or an auto company, say Tesla or Ford. These entities issue bonds to raise capital, so they are in essence raising money. So the money the entity raises helps fund new projects or internal operations. The purchasers of bonds are the investors. They're called bondholders. So if you buy a few bonds from, say, Tesla, you become a bondholder of Tesla. You, as the bondholder, there are two things that you should expect from Tesla. You need to have a quarterly or biannual or annual interest payment. So that's a periodic payment. And then you get your money back. That's called the principal amount. You get it back at the end of the loan period. You get it at maturity. For example, let's say an individual bond will pay interest. The interest is called coupon to the bondholder, in this case you, the investor, at a stated rate of, say, 8% over a stated timeline. That's called the bond's term. Don't confuse maturity and the term. The term is 7 years, for example, but the maturity will be today's date plus 7 years. So if we are in 2020, then the maturity will be 2027, but the term is always stipulated in years, months, weeks, or days. If held throughout the entirety of that timeline, the 7 years, essentially known as holding it to maturity. And if the bond issuing entity does not default, the bondholder will receive all interest payments and 100% of their initial investment, aka the principal. Now, there is a risk that is worth talking about here. That's the default risk. So as a bondholder, you have a risk that if the company does not perform and the company does not have enough liquidity to cover its operations and also reimburse bondholders, the company might default. The company might file for bankruptcy. And if that happens, you're losing everything. You're losing your investment. Of course, in a bankruptcy, you get paid before the stockholders, but you will still be getting less than you initially invested. So most bond investors do not lose principal since there is no real market risk or risk of losing value. That's, of course, if there's no bankruptcy, right? And the interest payments are fixed. So this is why bonds are called fixed income investments. They're called fixed income investment because you get your interest every quarter or every 6 months or every year, and you get your money back at the end of the term. Again, that's if the company does not file for bankruptcy. If we go back to our hypothetical example here, Tesla, I don't think Tesla is going to file for bankruptcy. The company is doing pretty well, very, very well. Investors are happy. The sales prospects are very good. So chances are this is a company, of course, nobody can predict the future, but my feeling here is that this is a solid company that's not going to file for bankruptcy very soon. So if you are a Tesla bondholder, you are good. Now, that's for the individual bonds. Bond mutual fund, that's another total different animal here, guys. So bond mutual funds, however, do not share this important aspect, which adds to the risk that bond mutual fund investors could lose their principal investments. If you buy an individual bond, if you buy the bonds of an individual company, you are pretty safe as long as the company is well rated, probably AAA or AAA or triple B, you're fine. But if you buy shares in a bond mutual fund, things are different. I'll speak about that later on. Speaking about the distinction between bond and bond mutual fund, let's just dig a little deeper here. Bond funds are mutual funds that invest in bonds. Put another way, one bond fund is essentially a basket of dozens or sometimes even hundreds of underlying bonds being held within a bond portfolio. Most bond funds are comprised of a certain type of bond, such as corporate or government. They can further be defined by the time to maturity. So there are various ways to distinguish between bond funds. It could be the underlying assets. It could be the maturity, the time to maturity. Maturities are usually grouped as either short term, less than 3 years, intermediate term, 3 to 10 years, or long term, 1 decade or more. So when you hear the term short-term maturities, long-term maturities, or intermediate term maturities, we're talking less than 3 years, 3 to 10 years, or more than 10 years. Individual bonds can be held by the bond investor until maturity. The price of the bond may fluctuate while the investor holds the bond, but the investor can receive 100% of their principal at the time of maturity. In other words, if you are a bondholder, going back to our example of Tesla, if you're a Tesla bondholder, as long as you hold the bond till maturity, you're not going to lose any money. You're not having any loss in terms of the capital, because whether the bond's price goes up or down in the interim, that's just what I call the unrealized capital gains or losses, and those are the vicissitudes. Those are the bond's responses to the vicissitudes of the market. The market goes up and down. That's what the market does. It's the nature of the market. So you don't have to sell the bonds. As long as you don't sell the bonds, you're fine. You will receive your quarterly or biannual or annual interest payment, your coupon payment, and your full investment, the principal, at the end of the term, the maturity. So you're fine. Bond mutual funds, though, work differently. With bond mutual funds, the investor does not directly hold the bonds. Bond funds carry greater market risk than bonds because the bond fund investor is fully exposed to the possibility of falling prices, whereas the bond investor knows exactly how much money they'll make if they can hold their bond to maturity. That's the main distinction between bond and bond mutual funds. Another interesting aspect of the conversation when it comes to creating a bond portfolio guide is to understand why bond prices change when interest rates change. There is an inverse, economics call it an inverse relationship between bond movement and interest rate movement. So when interest rates rise, bond prices fall, and when interest rates go down, bond prices increase. So this inverse relationship can seem a little confusing at first glance, but a real life example can provide a better sense. Before we get into the example, let's just first lay some groundwork. Bonds are different from stocks. That's for sure, you understand that. So unlike stocks, which represent ownership in a company, bonds are a type of loan made by an investor, typically to a company or government agency. So when it comes to the United States government, for example, we have the U.S. Treasury bills or U.S. Treasury notes, UST notes, and UST bonds or UST bills. In return for that loan, the investor received fixed rate interest income, usually quarterly, semi-annually, or annually, which remains the same despite how market interest rates might change. This is where the things become a little interesting. So let's say you hold Tesla bonds for 10 years, and Tesla has agreed today to pay you 5% annually, a coupon rate of 5% annually for the next 10 years. What if 2 or 3 years from now, interest rates go up? Let's say to the Fed's overnight rate is around 7%. The market rate is around 7%. In other words, if you had that money that you invested with Tesla, you could have been earning 2% extra. And instead of doing that, your money is sitting in Tesla's coffers, giving you 5%. That's the risk. That's the interest rate risk here. So bonds essentially compete against one another on the interest income they provide to investors. When interest rates go up, new bonds that are issued come with a higher interest rate and provide more income to investors. When rates go down, new bonds issued have a lower interest rate and are not as attractive as older bonds. Unfortunately, when rates go up, the older, lower rate bonds cannot increase their interest rate to the same level as the new, higher interest rate bonds. The older bonds are locked in, right? They cannot change based on the original terms. That's what I was telling you earlier when I was alluding to the Tesla example. So as a result, the only way to increase competitiveness and value to new investors is to reduce the price of the bond. But as a result, the original bondholder may be holding an investment that has decreased in price and doesn't pay as much as they could get for it right now on the market. So if I give you the example of when we go back to the Tesla example, if you hold Tesla bond, the bond pays a coupon of 5%, and 2 or 3 years later, the market rate, the average market rate goes to 7%. That means that the Tesla coupon is lower than the 7% by 2%. So the Tesla bond has to decrease in value so that it is still attractive to invest to new investors or to even existing investors. But you, in this case, you bought the Tesla bond at, say, 100. If it goes to 95, as long as you don't sell it, you're fine. If you sell that bond, that's when you get the -5, the loss. That loss becomes realized. That's what I wanted to tell you in terms of the movement of interest rates versus the movement of bond prices. I'll be right back after this. Welcome back, folks, to another edition of Sweetie Kiwi. I hope you are still having a conversation. You're still finding this conversation interesting. We're still talking about the basics on building a portfolio of bonds. And if you love the content's clarity and quality so far, please consider subscribing to our channel and turn on the notification bell so you are aware of new shows whenever we drop them. And we drop this kind of shows every single day, rain or shine. Let's talk now about the basic types of bonds. So we have corporate, municipal bonds, treasury, and junk bonds. So there are several types of bonds, but the basic types include corporate bonds, municipal bonds, treasuries, and junk or high yield bonds. When you hear the term high yield, it means high return. Yield means return in financial parlance. So U.S. Treasuries securities, also known as treasuries, are debt obligations issued by the United States Department of the Treasury. So when you buy treasuries, in essence, you are financing the operation of the United States federal government. In other words, you are loaning money to the federal government. So there are 4 types of treasuries. You have the T-bills, treasury bills, which mature in 1 year or less. Treasury notes, the T-notes, those mature in 2 to 10 years. You have treasury bonds, the T-bonds, which mature in 20 to 30 years. And then you have the TIPS, the Treasury Inflation Protected Securities, which are inflation indexed bonds. That's for U.S. Treasury securities. The second category of bonds are corporate bonds. Those are debt obligations issued by corporations to raise capital for corporate projects or other means of expanding the issuing corporation. So when you purchase a corporate bond, you are lending money to a corporation, not the government, but they work the same. Investors receive a specific amount of interest until the stated maturity date, at which time the original amount of the bond purchase is returned to the investor. Of course, when it comes to, I said that the process works the same, but the the creditworthiness of the United States government is unparalleled. You cannot compare that with the creditworthiness of a regular company, right? So a regular company might file for bankruptcy, might default on the bonds, but that will not happen to the United States government. So that's for corporate bonds. Municipal bonds, those are bonds issued by government municipalities or their agencies. So examples include cities, states, and public utilities. The debt obligations are used to raise money to fund the building of schools, parks, highways, and other projects for public use. The fourth category of bonds is junk bonds, also known as high yield bonds. Those are bonds that have credit quality ratings below investment grade. So that is a rating below triple B by Standard & Poor's or below BAA by Moody's credit rating agencies. Remember, AAA is the highest. When it comes to bond rating, you have three main institutions. So you have S&P, Standard & Poor's, Moody's, and then you have Fitch ratings. So a bond can receive a lower credit rating because of the risk of default on the part of the entity issuing the bonds. Therefore, because of this higher relative risk, the entities issuing these bonds will pay higher interest rates to compensate the investors for taking the risk of buying the bonds. Thus, the name high yield. As I said, the return, the term yield means return. When I was talking earlier about the fact that the rating agencies are putting a lower rating on a company because there might be a default. Remember, there could be internal reasons for that downgrading or external reasons. So internally, the company might be mismanaged. They might have some liquidity problems. They might have some cash problems. Or it could be externally. Maybe the company is operating in a sector, in a country that is not economically viable over the term of the bond. In other words, if the bond's maturity is 10 years from now, and economists believe that the sector or the country is not viable over the next 5 or 7 years, they might recommend that the bond of the company be downgraded. That's when you hear the terms downgraded. So they go from AAA, for instance, to triple B, or AAA to a lower grade. So if you are interested in building a portfolio of bonds, besides listening to what the rating agencies are saying, you need to also learn how to research and buy bonds. So you don't have to be an expert to do bond research. All of the knowledge, terminology, and complexity involved in bond markets can be accessed simply with a few useful strategies and websites. Nowadays, we're very lucky. We live in a world where the internet is prevalent everywhere, and you can just either through your phone or through a desktop access a wealth of information about bond investment. Bond analysts and credit agencies do most of the work for you by evaluating the bond risk and assigning a corresponding rating, a grade. So therefore, the bond investor only needs to know where to look and know how to interpret the information that already exists. So you can use mutual fund research sites to see what some of the best mutual fund managers are holding in their portfolios for some ideas. Then you can do your own research by looking at sites like investinginbonds.com. You have sites like Moody's.com. There are tons of sites out there, financial and investing websites that give you a lot of info about investing in bonds. Whichever financial institutions you use for a brokerage or retirement account will also likely give you access to a bond's credit rating and other investing insights. The next thing you also need to do is to avoid overlap, and you want to seek diversity. The old rule about diversification and not putting all your eggs in the same basket applies also to bond investments. So as with mutual funds, overlap can occur with buying individual bond securities. So you need to build your bond portfolio with a diverse mix of maturities and bond types. So maturities, if you remember earlier, I was talking to you about less than 1 year, 5 years, 10 years, and 30 years. And you also want to have a diversification in terms of bond types: treasury, municipal bonds, corporate bonds, high yield bonds. So you have a nice mix. So within your corporate bonds, try to diversify the industries you are exposed to. So don't put all your eggs again into the same industry basket. So if you want to put a little bit of your money in financial, a little bit in healthcare, a little bit in manufacturing, a little bit in retail. That way, if stuff happens over the maturity or over the maturity of one bond, you're covered because the others will perform better. Even if the whole economy goes down, this is only temporary. But if you're well diversified, chances are you're not going to lose your money at least for 1 or 2 or 3 or 5 years. If you think about it, the last time we had a recession, and that was in 2008, and even right now we're having some kind of recession related to the global pandemic that we're currently going through, the COVID-19. You still have sectors that are relatively doing fine. And even if the market tanked for 2 weeks or 3 weeks, the market is still up. And as long as you're diversified, you're not feeling the pain right away. You might feel some little pain here and there from time to time, but not a full pain. And that's the goal. That's the deal here. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're also having a conversation here around the basics on building a portfolio of bonds, and I enjoyed this conversation. I hope you are enjoying the conversation too. If you have questions, please don't hesitate to put questions in the comment section, and our team will certainly get back to you. We read all questions, and we always respond to the relevant ones. Relevant meaning question that is relevant to the topic we're talking about today, which is bond portfolio, how to build a bond portfolio. So the next thing you want to think about is to consider a primary and secondary portfolio structure. How do we call that? What is this? Some experts call such structure a core and satellite portfolio structure. So even if you feel the price risk of mutual funds will be prevalent for quite some time, there is no reason to abandon bond mutual funds completely. So for diversity's sake, investors will be wise to consider owning at least one bond mutual fund as a core fixed income holding, then building additional investments around that core. So you have the primary and the secondary portfolio structure. So the primary here is the bond mutual fund, and the secondary portfolio structure comprises the individual bonds. It is the type of core and satellite structure that is common with complete mutual fund portfolios, though mutual funds typically include stock mutual funds in addition to bond mutual funds. The bottom line here is to have a structure that allows you to navigate any market over a long period of time. And long period of time here means 5 to 10 years or even more. So by having this secondary or even tertiary portfolio structure, in other words, you have the primary being the bond mutual fund, the secondary being the individual bond or ETFs or index funds, and then the tertiary structure being the individual bond itself, or a basket of individual bonds in sectors as varied as financial, healthcare, manufacturing, or retail. All right, folks, thank you so much for today's conversation. I really appreciate it. I'm going to quickly give you a recap of our talk today. So I talked to you today about understanding the basics of bonds and bond funds, learning the distinction between bond and bond mutual funds, a little bit of talk about why bond prices change when interest rate change. There is an inverse relationship here. Knowing the basic types of bonds. Here I was talking about junk bonds, treasury, municipal bonds, and corporate bonds. Also talk about how to research and buy bonds, avoiding overlap and seeking diversity. And last but not least, considering a primary and secondary portfolio structure. I will see you next time, but until then, remember, stay.